for your time and in having us for the presentation regarding Brazilian aspects on transfer pricing post-COVID, country best practices, methods, and analysis. So I have organized the agenda with an overview of the Brazilian transfer pricing legislation, which I think would be useful for all of you. And then the COVID-19 impacts and measures, and then the Q&A. So the most important thing after hearing the presentation from you all is that Brazilian legislation, transfer pricing legislation, is slightly different from the OECD standards. So basically, even though our legislation the legislator intended to be close to the OECD guidelines, it's actually not. So that's why I wanted to explain a little bit about how transfer pricing works in Brazil. So the operations covered are import and export operations between Brazilian legal entities and foreign related parties, or with parties that are not related, but located in tax havens or in low tax jurisdictions. And also such operations when there is an interposed party, such as a trading company or any other party that may act as an intermediary in the operation. These operations are also subject to transfer pricing control, so that no important data is lost when there's this intermediation. Also, financial operations between Brazilian entities and related parties are located in tax havens or low tax jurisdictions are subject to transfer pricing control. Regarding the interests, so there are specific rates for the interest, and there is also the capitalization control. TP in Brazil is not applicable to royalties, and when the company is under the presumed profit method that is calculated only on the gross revenue, TP is only applicable to export operations. So the import operations is not then covered by TP. Usually the companies are under the real profit method that is applied on the net profit plus add-backs minus exclusions. So the calculation basis involves the net profit in a whole. So of course, both revenues and expenses must be tested. But for the presumed profit method, that does not apply, of course, only to export operations. So regarding intercompany import methods, the most important thing is the deductibility of the costs and expenses regarding the operations. So these costs and expenses, they may not exceed a perimeter price, as it's called. So when we are performing TP calculations, we calculate the perimeter price, which is the price that is allowed, and the price used, the practice price, as we call. So the difference between one and the other may be an adjustment to the tax calculation basis, to the corporate income tax calculation basis. So for import operations, we have the PIC method, which is the comparable independent prices. When you compare the amounts you charge in your transactions with the weighted arithmetic average of the prices of identical or similar goods or services practiced in other countries in similar operations. So the prices of goods, services, or rights acquired abroad from a related party are compared with prices of identical or similar goods, services, or rights sold by the same exporter to a resident or non-resident unrelated legal entity, acquired by the same importer from a resident or non-resident unrelated legal entity, or in purchase and sale operations carried out between resident and non-resident unrelated parties. That's an extensive rule, but it's basically comparing the operations that you practice with similar operations in conditions that are not between related parties. That is a comparison method. There is the PRL, which is the resale price, which compares the amounts charged with in related party transactions with the arithmetic average of the real sale price charged for goods or rights, minus unconditional discounts granted, taxes and contributions levied, commissions paid, and a profit margin of 40, 30, or 20% depending on the industry, as shown in the slide here. The CPL is the cost plus method, where you compare the amounts charged, the cost charged, plus a profit margin of 20%. So your cost, your expense cannot be higher than the cost, the original cost, plus a 20% profit margin. There is also the PCI method. That is exclusively applied to commodity transactions. So there is a comparison with the main exchange, exchange commissions and stock exchange, not stock exchange, but the exchange of commodities, the ruled prices from the exchange entities. I'm sorry, I think the cost plus I was reproduced here again, but we already covered it. Sorry about that. So these are the import methods. Regarding export methods, we have first of all the safe harbor rules. So when you have revenues from your related parties operations is that are less than 19% the average price for the sale of some of similar identical goods in the Brazilian market, you are under the absolute safe harbor. So if you're under this rule, you are not obliged to the transfer pricing control. And there, if you do not fall under this 19% rule, you can also try safe harbor 1 and 2 rules that comprise that legal entities proving regarding safe harbor 1 first. If legal entities are proving that they have assessed a net profit from export operations alone of at least 10% of the total of such revenue, considering the revenue, the average of the last 2 years, you are released from the transfer pricing control for export operations, provided that the net revenue regarding related parties is not higher than 20% the total net revenue. And this is not so easy to apply, so most companies look for applying rule number 2 for safe harbor, that is having your export net revenue not higher than 5% of your total net revenue from your entire operation. So if you fall under these rules, you are also not subject to transfer pricing control. If you are not under safe harbor, then you go to the export methods that are PVEX. That is the weighted arithmetic average of the sale prices on the export operations carried out to other unrelated clients or carried out by another national exporter of identical or similar goods, sales, or rights during the same tax year and in similar payment conditions. The PVA method is the weighted arithmetic average of the sales price of identical or similar goods practiced in the wholesale market in the country of destiny in similar payment conditions minus taxes and a profit margin of 15% of the wholesale price. PVV is the weighted arithmetic average of the sale prices of identical or similar goods practiced in the retail market in the country of destiny in similar payment conditions minus taxes included in price charged in such countries, and a profit margin of 30% on the retail price. And the most used method is CAP, which is also the cost plus, but now for export operations, where you have your cost plus a minimum margin of 15%. You can have, this is the opposite. So as it is an export operation, you may have a margin higher than 15%, but not lower than 15%. So your revenue must be higher than such a percentage of profit, but not less than that. For commodities operations on the export side, you have PSEX. That is also the comparison of your price with the commodities exchange prices, depending on the commodity that you are trading. The margin of divergence of 5% is allowed. So if your price if your practice price varies, sorry, from the perimeter price in up to 5%, that is okay. You do not have a transfer pricing adjustment to be taxed. You can be fine with this margin of divergence. And this margin is 3% for commodities operations under PCI and PSEX methods. Regarding interest, the deductibility of interest is also tested. So the margin of spread is tested against with prefixed rates. So the rate that is used is the Brazilian sovereign bonds issued in the foreign market in US dollars with a prefix rate in case of US dollar operations. And for other cases, the interest rate is LIBOR for 6 months. And besides that rule, for interest operations, you also have thin cap rules. So your interest expense will be deductible provided that the total debt is not higher than certain percentages on the company's equity. So if the operation is with a related party which holds interest in the Brazilian entity, the debt may not be higher than twice such equity. If the related party does not hold interest in the Brazilian entity, the debt may not be higher than twice the total equity of the Brazilian entity. And in both cases, the sum of the debt cannot be higher than twice the sum of the interest held by all parties involved in loan transactions in the Brazilian entity's total equity. If the operation is conducted with a tax haven or low tax jurisdiction, the sum of all debts may not be higher than 30% the Brazilian entity's total equity. And then there is a formula to calculate the interest. That is there are those two formulas here. That is how you test your interest expense. Regarding COVID-19 impacts, there are not specifically impacts regarding transfer pricing, besides, of course, the impacts on the operations themselves. We have seen that sectors as aviation, hospitality, transportation were very affected here in Brazil. So, of course, in our engagements, we see a lower of operations of such sectors. However, some other sectors have presented significant growth, and what we have seen is that they have increased their import operations for raw materials a lot. that are the sectors such as supermarkets, glass industries, because of the refrigerators from the supermarkets, mostly film industries that were producing those shields in the masks, or the shields in the supermarkets, in the cabs, pharmaceutical and personal care products. However, the government has introduced some other measures um, to help the population. One is, I believe, being implemented all over the world, which is the emergency aid for people with lower income. So the government has paid money to such individuals. We have seen and the postponement of payment of taxes and tax returns as well. And the government has also allowed the companies to reduce the employee salaries, and the difference between your regular salary and the one that the company would pay would be paid by the government. And such payments and the payments that you made would not suffer social security taxation. So that was a very important measure for companies here in Brazil. And that was my presentation. I'm sorry if it was too quickly, because I think the content was perhaps more extensive than 15 minutes, but I am available for Q&A. And I also bring our contacts if you need any assistance from Brazilian side.